Hey, everybody. So glad you could join us this evening. Do me a favor, type in the chat box. Make sure you click the drop down to everyone, but say hi. Tell us where you're joining us from. Everybody's piling in. Ottawa, Montreal. Oh, hello, Janelle. Good to see you. Trevor, Ottawa. Wow, Ottawa's representing. Literally, hey, Adam. Literally, almost everyone so far is from Ottawa. What is going on? These must be all your people, Christian.
Yeah, nobody from BC.
Ottawa's super cool. The coolest people live in Ottawa.
Absolutely. Oh, Carl's not from Ottawa. No, you are correct. Can Christian ran a campaign? That's hilarious, Team Christian. Love it. I'm actually in Ottawa this week too, and thoroughly enjoying every minute of it. So glad everyone could join us this evening. We are gonna get started right away. There we go. Everybody's piling in still. Welcome, welcome. Thank you so much for spending your Monday evening with us. Can everybody see my screen? Corey, can you give me a thumbs up, please?
You betcha.
Fantastic. Thank you. All right. Welcome, everyone. Thank you for joining us on Monday, September 11th. We are going to be talking this evening with some absolute powerhouse titans from the real estate world, and we're going to be talking about tips from real estate investors who have been through it all. So these are people who have tons and tons of experience. They were investing in 2008. They might have been in Alberta in 2016. Christian has been just in the investment space for upwards of 3 decades. And Dalia looks at more deals in a week than I think most of us see in a month. So a ton of experience in the room tonight. Thank you so much to everyone for joining us. And grab your notepad and your pen and get ready to take furious notes. I will let you know, though, you will get the recording as soon as it's done with editing. So this will automatically be sent to you because you registered for our event this evening. Our agenda is basically a quick welcome and intro because we want to dedicate as much time as possible to talking to the speakers and giving you the opportunity to ask some questions. So we'll do a quick welcome and intro. We'll just do a little bit of housekeeping, and then we will have the speaker introductions, and then we will move on to the discussion. And our speakers are so diligent, and they always provide these fantastic bios. And I have to say, everybody who is with us this evening has been hand-selected for a very specific reason. So Dalia, of course, is with us because she is, in my view, the #1 mortgage broker for investors in the country. Hands down, way more knowledge. She just helps us approach investing like a business, which that's what we need now. Every time we turn around, you know, the lenders and the Bank of Canada and CMHC, they just keep moving the cheese around, and we spend all this time chasing it and trying to catch up. And, you know, we develop this plan. Okay, I'm going to buy a multi-unit building, and in 3 years, I'm going to do this. And they're like, no, you're not. So Dalia is the one who helps us navigate the craziness that goes on out there. Dalia, I'm so glad you could join us this evening.
Elizabeth, Corey, thank you very much. I'm honored to be here. Thank you.
Wonderful, thank you. And we have Christian, who, as most of you know, if you've been part of my world at all, you know how much respect I have for Christian. His mind, he's so unique. We're in the backstage waiting to start the webinar, and Christian's showing us all these like super intellectual books, and I'm literally like, wow. Smartest man in the room in most rooms. So Christian, we very much appreciate you lending your experience and expertise to us this evening and sharing with us your takeaways from 30 plus years investing in a variety of different commodities.
It's going to be super fun. I'm looking forward to it.
Wonderful. Thank you. And we also have James Knull, who is a veteran realtor. Am I allowed to say realtor, or do I have to say real estate agent?
Either or is fine with me.
Okay, Perfect. So James is a veteran in Western Canada, has a ton of experience, loves helping investors, and is an active investor himself. And you talk about seeing the highs and the lows. When you're investing in Alberta, you go from, riding the wave to hitting the bottom of the ocean. It happens pretty fast. So you need to be prepared and you need to know what's going on. So we're really fortunate to have James here with us this evening. Thank you, James.
Happy to be here. Excited to be part of the conversation.
Wonderful, thank you. And then our other panelist was Michael Ponte, and unfortunately he's had a scheduling conflict, so he's actually going to be jumping on to our webinar next week. Not unusual that most of our people have so much experience, they could probably talk about pretty much any topic. So Michael's going to pop on with us next week and sends his regrets to everyone. And then, of course, my partner in crime here is Corey Spurley. Corey and I met early last year when he was hosting an online summit, and we have spent a ton of time together. Like, we know each other really well now, don't we, Corey?
Yes, it's safe to say.
Yeah. And it's funny, every time I see Corey say something on social media or do something on social media, he never ceases to amaze me and surprise me with some of the insights and some of the great information and experience he has. So we're really fortunate to have such an amazing group this evening. And my name, of course, I'm Elizabeth Kelly, and I'm a real estate investor and a coach. I've been an investor for almost 20 years. And we've seen a lot in that period of time. And I know that if you are relatively new to the real estate space, there's been a lot of hype and there's a lot of, there's a lot going on right now. It's not an easy time to be an investor. So we really wanted the opportunity to kind of give back to the community and share some of our lessons, some of our expertise and information that we've gained over the last 20 years. So with that being said, thank you to our panelists. Thank you to everyone attending. So just a quick reminder, please use the chat box. So click the drop down in the chat box, make sure you change it to everyone, and then use that in order to interact with other people, to interact with the speakers. But when you have a question that you would like us to address at the end, because we've reserved quite a bit of time this evening to address attendee questions, make sure you use the Q&A tab. So you should also be able to see that at the bottom. The Q&A tab holds the questions for us so that they don't get lost in the chat. And then the chat is just to interact with the speakers. So with that being said, we all have a choice, and I'm so glad each of you is here this evening because you are making already some good choices, because there will be some people who are just going, I have to survive until 2025. I just have to drag my butt through. I have to figure out what I'm doing for my cash flow. I just have to curl up into a ball, pull the blanket over my head and hope that I survive. And then there's going to be other investors out there who are like, I am thriving. I am out there. I am doing deals. I'm getting financing. I'm jumping on opportunities. And we're going to spend quite a bit of time this evening talking about what do we need to do to move from surviving into thriving. So that brings us to our very first question this evening. And I think maybe we will start with the gorgeous Dalia. Dalia, can you tell us what patterns you're seeing from other times when there were market challenges? Maybe it's 2008, or I know you do financing for investors across the country, so I know you help with financing in Alberta and all the other provinces except Quebec. And I'd love to hear kind of what you have to say in terms of what you're seeing right now.
So, Elizabeth, if you remember, 2008 was the beginning of the financial crisis, and when there is a crisis, the bank tends to take extreme measures to lower their overnight rate, which is what they've done leading to 2009, and the overnight rate dropped to 2.2 something at that point, which is similar to what happened in 2022 with COVID. So the slide, right, of the Bank of Canada rate. And then since 2008 leading to 2020, right, we saw the rates, climb a little bit, go down a little bit, climb a little bit, go down a little bit, and then until where we are right now with this sharp increase, which, is similar to the last sharp increase that I have seen of similar magnitude was back like about 15 years ago. So at the end of the day, it's a pattern, right? And the pattern is when there is a crisis, the bank tries to stimulate the economy, and then when they are fearing inflation, they're trying to stop it as fast as possible through the rate as a tool. So we are now in the height of the tightening of monetary policy, at the height. And I know a few months ago, everyone thought we're gonna, we've hit the peak and we're pausing, and the Bank of Canada gave that signal, but they came back and increased again. So what I'm seeing is anticipation right now as to what is going to happen next. Are we at the peak? Is this done? Are we now going to sit there for some time before we start to see some relief, or is there more coming? Lots of anticipation and lots of pressure, I would say, in the investment community on cash flow, people coming out of renewals into higher rates. And I don't have the crystal ball, but I am connected with many premier rate analysts who breathe rates day in and day out, even, way beyond me. And the prospect is we are pretty much at the peak, but everything is now very data dependent. So if inflation comes in hot or high, there is a possibility for, one more. So, but are we at the peak? Are we close to the peak? Yes, absolutely. So very similar patterns, stimulate the economy and then very aggressive increasing inflation. And then everybody's waiting to see, okay, are we there yet, or we're not? And we're pretty much there, but there is a possibility for one more if the data on the inflation side shows that it's not, it's not coming down, despite the fact that GDP has taken, a little bit of a decline, and unemployment is, starting to tick up, which are indicators that the Bank of Canada wants to see. There is that possibility, and it's really data dependent. But in terms of magnitude of increases, any big magnitudes seem to be pretty much done.
Fantastic. So this is not the time when you would recommend people lock into fixed rates at this. You would recommend they hold off and stick with variable and look at locking in the future as things start to come down.
So for investors who are already on a variable rate, if you are able to hold where you are, you will benefit from the slide down, which is not going to be as fast as the climb up. The slide typically happens gradually, and it's expected to happen sometime in 2024 Q3. So those who are on a variable rate, I'm advising to stick with a variable rate. But if you're going to make a decision, a new rate decision, to whether to go variable or fixed, when we crunch the numbers are pretty close right now. Like I would say 1 year would take you to mid of 2024, a 1 year fixed, and it's below where the variable rates are. So you could still benefit from a reduction then. And then the 2 years is really taking a bet right now, right? Because this target of 2024 may shift depending on the data. So those who are taking a 2 year fixed will still have a lower payment than taking a variable today. But they may, they're bidding on whether the reduction in rate is going to happen mid 2024 or later on. Either way, 1 year, 2 year variable rate. I'm not suggesting anything longer at this point, so that you want to benefit when the Bank of Canada starts to pull their feet off the pedal, basically.
Awesome. That is fantastic. Thank you, Dalia. I think everybody's going to be jotting notes there so that when we're running numbers, we have a bit of an idea of what we should be running numbers based on. Thank you for that. James, you have been in Alberta. It's been a wild ride the last 15 years in Alberta. What can you kind of share with us? What insights do you have about patterns you've seen or predictions you have for the next few years for investors?
Yeah, that's a great question, because we actually went through a similar market cycle in 15-16 that applied very similar pressure to investors. the difference at that time was instead of interest rates going up to make it a bit of a cash flow crunch, at that time, the market stalled and the rents came down. So instead of having a higher expense, which is what we're dealing with right now, at that time we had lower revenue, which created a very similar disparity between rental revenue and expense. A lot of people went into negative cash flow situations, making it really, really tough on people. So the first thing I would say is, if you are a larger portfolio holder and you are watching this wave of renewals come towards you, and you've done your math and there's no way to do the math that shows that you're going to be able to positively cash flow, it's okay to deleverage your portfolio a little bit and reposition. Oftentimes as real estate investors, it's always buy, always hold, never get rid of anything. But from my experience, a portfolio has a little more fluidity to it. And sometimes you have to get rid of properties that don't make sense anymore, especially if those properties are going to put you into a serious negative cash flow situation. So I would say, in anticipation of renewals causing a problem, or if you're already in a situation where renewals are causing a problem, have a really good analysis of your portfolio that might require some liquidation to deleverage in order to be in a position where you're not bleeding too much cash. The second recommendation that I would make is, if you are in a position where your renewals are coming up right now, it's okay to be in a position where you take a variable rate mortgage, because the penalty for exiting most variable rate mortgages are 3 months of interest versus locking yourself in for 2, 3, 4, 5 years. So if you're liquidating, give yourself room with your business plan to liquidate so that you actually have an exit strategy involved for your properties. So that's kind of the first thing I would say. The second thing that we really learned at that time is that the people that struggled the most were the ones that were over leveraged, because high leverage means you borrowed more money. Borrowing more money equals making more payments. And again, in a situation right now where the rents aren't typically high enough to cover the increased payments, you're going to negatively cash flow if you just borrow too much money. So I would advise people to be very, very cautious with strategies like using a line of credit as the down payment for your property and expecting it to cash flow. I would also suggest to people that you put in oversized reserve funds. When the cash flow is really high, you can get away with smaller reserve funds. But in situations like this where cash flow is really, really tight, when you initiate your project, when you start up your property, it's really conservative and really, really smart to have a larger reserve fund. So this is a purchasing environment where big reserve funds make sense. Leaving a little bit of cash on the side makes sense. Having a little bit less leverage makes sense, because leverage is expensive. And if you can't hold on to your properties because the negative cash flow is breaking your back, you're going to have nothing to show for it at the end of this cycle. So it's okay to have fewer properties and make it through than to have no properties. So that would be kind of what we learned in that cycle is, leverage is definitely our friend in real estate, but over leveraging ends up causing us a lot of trouble.
Absolutely. I couldn't agree more. And it's funny how, we start investing and, we have this, oh, I want to buy one property a year. I want to buy 2 properties a year. And all of a sudden we morph into like these property hoarders. And, even when the numbers are saying sell or reposition or do something different, we're afraid. We think that it means that we're a bad investor if we sell. And the reality is most investors have sort of a natural turnover in their portfolio. We start by buying smaller buildings, and most of us, I mean, some people go immediately to large multifamilies, but a lot of us will start off and sort of grow into bigger buildings over time and into different strategies. James, have you seen in the past that there is a landslide of opportunities coming towards us? Have you seen that all of a sudden there's going to be a bunch of people who can't afford to hold on to their buildings, so there's going to be the opportunity to pick up some deals in the next couple of years?
I think we are going to see that coming. I mean, I think that the difference between the market we're dealing with now and what it was like in 2015 is immigration numbers are spiking. There's a student housing rental crisis. There's an inventory mismatch. So there's a lot of factors that are driving the market right now that weren't driving the market in the same way in 2016. So I think the higher interest rates are buffering growth as opposed to stalling it. That being said, there's going to be people that can't hold on. I think a really good window of buying opportunity is actually going to be this winter, because there are still a ton of buyers who haven't gotten used to the new market reality that are in wait and see mode. And we're going to see those renewals start to come up, in inventory that didn't get sold in the summer, inventory that didn't get sold in September, start to sit stale on the market. There's a lot less inventory right now than there was in 2016. Right now, there's actually a bit of undersupply. In 2016, we saw record numbers of listings, so there was almost an oversupply. So in order to navigate these windows of timing, I think that this winter is going to be really good timing, because if the Bank of Canada doesn't keep raising interest rates, investors usually take about 4 to 6 months to just get used to whatever the changes are. So for example, when we added the stress test a few years ago, there were a lot of people that just said, I'm just going to wait and see what happens. And then once they realized the stress test wasn't going away, people started taking action again. Or when the amortization got scaled back from 40 years to 30 years. Again, there were a lot of people that thought, oh, this is going to be a problem. Let's wait and see what happens. Once it becomes the new normal, people start taking action again. So we're in this little window of opportunity where we're going to have a naturally slow winter market, in combination with the fact that people are still uncertain because the changes haven't become the new normal yet. And when the changes haven't become a new normal, a chunk of people are afraid to take action. So when other people aren't acting and there's an opportunity, that's a really good time to move forward as an investor.
I love that. And what I would take away from that, James, from what you said, is if we can position ourselves and take action in less than 4 months, we're going to be leading the herd versus following the back end of it. I love that. I love that you could put a timeline on that. Thank you. Corey, do you want to jump in and talk a little bit about Alberta, and then we'll circle back around to the OG over there?
Yeah, I'm going to steal one of his lines. So thankfully you asked me first. Christian told me once, on a renewal, it's like, once, and I got to be careful because Dalia is right beside me here, is, once, when the bank has the money, they have control. Once they've given it to you, you have control. So just because you get a renewal letter doesn't mean you have to immediately do it. There's negotiation. And I actually did that, and it kind of went back and forth. We had one of my commercial properties, they asked for an early, I was just going to renew, and they decided they weren't going to do it, so I had to refinance. But I used some of Christian's trickery there. I wouldn't say trickery, but it's a fantastic strategy. It worked really well. But the differences between 2008, like 2008 was the great financial crash. I mean, we didn't have a housing crash like we did like they did in the United States. Alberta was hit, not that hard. I mean, it was the gas sector imploded more than the oil one. So that was when fracking came in. So Grand Prairie and these smaller areas got hit hard. But it was the oil crash in 2016 that James was talking about that really caught a lot of us Albertans off guard. In Saskatchewan, it was even worse. I mean, we were 20% vacancies. So we really hit these 10-year cycles. And right now, actually, the position that a lot of people are in the flip side of it is we're finally seeing low vacancies and rising rents. James mentioned the stalling of rents. We're raising rents for the first time in 10 years in a lot of cases. So right now there's a lot of catch up, and I think there's another $300-400 in upside. I mean, we're still only at $1,200-1,300 for a 2-bedroom in Alberta. I mean, it's going to be $1,600 within 24 months. So that's why I say survive till 2025. On the flip side, on commercial, I also have renewals coming up. Deleverage, I cannot agree with that more. Deleverage and reserve funds. I mean, I have a modest amount of leverage. I was over leveraged on a couple properties, but that's one of the things I've done to optimize. And yeah, I'm very bullish going into this one because I see just the immigration numbers, what's going on, in the prairies and all across Canada. I think rents are going to continue to go up. There's going to be fluctuations in interest rates and housing values, but I don't see rents dropping across the country anytime soon.
Gotcha. Yeah, there's way too much demand. Way too much demand for rents to drop. Absolutely. Thank you, Corey. All right, Christian, time to weigh in and share your wisdom with us.
Oh God, no expectations set here. So, all right. So I'm gonna back up on a couple of things. So there's a bunch of things that are going on, and I'll tell you right now, the economy is incredibly difficult to predict. It's a very complex creature, right, with a lot of different moving parts to it. But what we do know is the pandemic was something different. Okay, so we kind of have to set that aside for a second. If we take a look at what's been going on from an economic perspective, going back, say, 20 years, we've seen a gradual cost of energy going up. And energy is an essential input to everything we do, everything. Food, products that we have, where we live, transportation, everything. So when energy starts going up in cost, what ends up happening is it drives inflation, and it starts to increase those costs. And that's something that is an underlying theme within our economy right now and going forward. So yes, the Russian invasion is an aberration. It certainly did increase energy costs, but there's other things such as ESG policies that are driving energy costs. Scarcity, even as we transition to green technology, these things are still going to increase the cost of energy, and that's going to create an input. And that's going to create a bit of a upwards pressure to inflation. And it's one of those things that's going to be difficult to keep inflation down below 2%. Of course, we could be wrong. There's so many things that can change it. The other thing then when we get from the pandemic is that, and actually before we get to the pandemic, so the other thing that was happening is since 2008, we've been in this constant cycle of trying to restart the economy. And that's why we've seen all these bizarre little cycles over the last 12, 13 years, actually more than that, maybe 15 years, where every time the economy started to lift a little bit, right, it would then just go into a recession, and then they'd have to stimulate to the economy again. And this is why interest rates from about 2008 timeframe to about 18 months ago have been really quite low all the way along. So what we've seen over the last 15 years is an aberration. It's not normal. It really isn't. It's been discount season for the last 15 years. Then just as things are starting to look good in 2019, and we saw some economic activity and there was a little bit of grace, they brought interest rates up a little bit, then the pandemic hit. And again, we're back into this situation where there's panic. Now, this time what they did was not just lower the overnight rates and the interest rates down to all the way down to a quarter point, basically free money. The second thing they did was quantitative easing, which they'd done a little bit in the past, but never to the scale that we saw in 2020. There was a lot of money. I think Canada alone, it was in the order of about 700 billion of quantitative easing that happened in the span of less than a year. And then it finally tailed off, but tailed off too late. So when we take a look at what's happening with interest rates right now, we saw the overnight rates going up, which of course affects every variable product. And that's what Dalia was certainly commenting on. But the other thing that we have to understand is that the fixed rates are based on the bond yields. So the bonds themselves, when they go down in value, the interest rates have to go up and vice versa. And if you take a look at what's been happening on the bond yield side of things, is there's what people call an inverted yield curve. What that really means is all the short-term rates are high and all the long-term rates are relatively low compared to the short-term rates. The theory being that whatever issue we're going through now is temporary. But what we've seen is the long-term bond rates have been coming up. So what I did, and this might be getting ahead of things a little bit, but one of the things that I've been trying to do is take a look at when we've got sales. Okay, and one of the things that we take a look at when we're looking at interest rates is sometimes the short-term rates are on sale, sometimes the mid-term rates are on sale, sometimes the long-term rates are on sale. So in the midst of everything that was going on earlier this year, right, people were saying, interest rates are going up and up and up. All I did is like, okay, well, I've got these assets that are renewing right now, and they are effectively long-term holds. I'm not planning to ever sell them in my portfolio. I'm going to pass them off to the kids, right? So I have a succession plan for that. So the 10-year rates were unbelievably cheap at the beginning of this year. And then when Silicon Valley Bank started to have its issues, right, there was this temporary bank crisis in the US that caused interest rates to drop down further. So I kind of panic bought a bunch of 10-year terms at that point in time, and it paid off well, right? And now I've got long-term rates of about 3.85%. So that works really well in terms, and those were at the end of March, right? So, but that's the kind of thing that I do in order to create ballast and predictability. And we can talk about interest rates all night long, right? But they are tools, and you have to manage them. Sometimes it makes sense for a variable rate, and James talked about some good reasons why you might want to have that. For example, if you've got short-term liquidity issues that you've got to manage, or you have to deleverage, then having those short-term rates are really handy. But on those long-term rates, if you're just looking for portfolio stability, sometimes you can still get what you want. So this is a bit of a backdrop to say, okay, when you take a look at what's happening with the economy, what we don't know is if interest rates are going to go down or when. Well, they will go down, but when? Who knows? So one of it is you've got to hedge against any possibility of what could happen. And we have to recognize that the Bank of Canada won't arbitrarily lower rates. They won't say, oh, you guys are suffering enough and therefore we're going to lower rates. Because here is a key takeaway from Benjamin Tall from CIBC, has said the Bank of Canada hates inflation more than they hate a recession. Okay, so what does that mean? The Bank of Canada isn't going to lower those rates until they're absolutely sure inflation is tamed. And then why are they going to lower the rates? The reality is they want to keep those rates relatively high, okay, because they need the room to lower it if there's a recession. So what happens if our economy goes into the proverbial soft landing and we don't actually trigger a serious recession in the next couple of years? Why will the Bank of Canada lower the rates? The only reason they would lower the rates is if they feel like they've slightly over-rotated and they're just going to bring it down a little bit. So that's a key thing to think about is we don't, even with the upward pressure of inflation because of energy costs, the uncertainty of whether we're going to really end up in a recession, especially as Corey was saying, we've had record immigration. 1.1 million people came into the country last year, which is more than double than what we've traditionally been able to do. That is going to help drive a lot more, the unemployment levels down, or more specifically, the employment levels up. So there's just a lot of pressure on the inflation factor and keeping it somewhat elevated and keeping it from coming down to 2. So I wouldn't be betting personally. I don't bet in the next year or two that interest rates are going to come down more than maybe a smidgen if they come down at all. Right. And then it's not going to be until we actually see real signs of a recession before we start to see a reversal. And they're going to lower rates only because they feel like they have to fight that recession. So that's the signs that you're really looking for. So my advice in general around this kind of stuff is very much about risk management, making sure that you think about what could happen, not what you hope will happen. Protect yourself, build reserves. Right, that's what I've been doing over the past 18 months. As interest rates are getting worse, I just figure out ways to build cash reserves so I'm ready and I'm prepared and I'm protected. Right, and if it doesn't manifest, right, and my predictions are all wrong, because quite frankly, I view my predictions as slightly better than random chance. Okay, so so that's why risk management is so important, and just protect yourself, prepare for what could happen, not necessarily what you hope will happen. Sorry, that was a bit long-winded, Elizabeth, but there was a lot to get out of there.
Yeah, well, and I think you did a good job, Christian, of kind of tying everything what people before you had said. Great information. You kind of tied it together and helped us make sense of it for those of us who are not like junior level economists. So we always appreciate your your teaching capabilities there and the education. Thank you, Christian. All right, so that brings us to the next question, which is, how would you handle a negatively cash flowing asset right now? So James has already sort of shared with us that you shouldn't be afraid to sell. Maybe what we'll do is we'll go through people in the same order again. Dalia, when people are coming to you and they've got a portfolio with a couple of properties, and not to name any pre-construction condo type things in the GTA, we've seen a lot of that, because I know there are some great pre-construction condos in various markets, but in Toronto, the pre-construction condo people are really struggling. So what would you tell an investor who came to you with a closing that they had to make that was really struggling? And I've actually seen a couple of people who are buying up to $100,000 over the actual fair market value to buy out their contract.
So Elizabeth, is the question about a current property that is yet to close that will be in a negative cash flow position as a result of the situation, or are we referring to an existing property within one's portfolio that is turned upside down?
That's a great question. And can we do both in less than 30 minutes?
In less than 30 seconds, 30 minutes? Okay, in less than 30 minutes, yes. 30 seconds, no. Okay, all right. So here's the first one is if you have a negative cash flow property within the portfolio. So I typically look at the entire portfolio, and if there is at a portfolio level, the portfolio is carrying itself, I will let it be because eventually the rates will come down. But if there are multiple properties that are dragging the portfolio down and the client is feeding the portfolio money to keep it alive right now, that's a different story. And that's where we have to look at a couple of things. Is there an opportunity to restructure debt? Would it make a difference? Can we stretch amortizations? Can we maybe clear something more expensive in their budget so that in a bigger picture, things balance out? So debt restructuring is one. Can they generate more income without, selling anything? I have one of my coaches taught me about something called deficit financing that I've never heard about before, and I'm actually implementing it right now. And what deficit financing is to basically take on temporary extra debt that covers the shortfall for the next 12 months or the next 24 months. And yes, it's digging a deeper hole for a temporary time period, but I would only do that if I know that I will be in a good position in 12 or 24 months. Like if I run my projections at a lower rate and I know that the situation is going to balance out, it's still the better strategy than selling the property off and getting hit with capital gains. Okay, so and losing the asset, because in the long term, if you look at real estate, in the long run, it's still an incredible wealth building vehicle. So if you're able to carry through these temporary down cycles, it pays off, tends to pay off over the long run. So selling obviously is the last resort. So that's how I would approach something that is negative cash flow within the existing portfolio. As for clients who have to close on deals, and these deals are in a negative cash flow position, one option is to go with an interest-only payment mortgage right now to reduce the pain a little bit. What I mean by that is either we, instead of the traditional way of going with a mortgage, let's take a line of credit or let's take a private at an interest only and still, be paying interest only versus principal and interest. It reduces the load a little bit. But in the long run, the client has to think about whether that property is the right property, for their portfolio. Because if they bought that condo at rates of 1 point something, thinking that the rates are going to stay at 1 point something for a long time, that's the wrong assumption to start like that. That's the wrong assumption, and that property may not be the right property, and they will have to liquidate it at some point. So. I mean, there is an extent to which we can fix a negative cash flow problem, but the last option, like James shared, is underperforming asset that no longer fits or is dragging things down, and there are no other options. You'll have to sell it.
Yeah, absolutely. Okay.
And I've seen investors actually bring also equity partners to their portfolios. Equity partners that would take an equity position in the portfolio, and they would be owning a piece and offsetting that negative cash flow temporarily, and that's their pay into the portfolio to own a piece. And again, as you'll have to show your JV partner that this is a temporary thing, and in the 12 months ahead or 24 months, the situation is going to change, because who's going to come into someone else's portfolio that is, going to continue to bleed for a long term.
Yeah. Absolutely. Yeah, it would have to be in a position where they're bringing in, cash reserves to deleverage the portfolio, reduce the debt obligations, and hopefully swing you out of a negative cash flow position.
Exactly.
Yeah, love it. That's great. Thank you, Dalia. What about you, James? I know you play quite a bit in the pre-construction condo space. How are things looking over there? Because the Alberta market is a little bit, well, it's a lot different than it is for us out here in Toronto, in Ontario.
Yeah, the Alberta market still isn't really a pre-construction kind of market, but I can tell you our Vancouver office is seeing a very similar phenomenon to what we're seeing in Toronto, where there's people that have to close on properties that they bought, a couple of years ago, and the interest rates are higher than they thought they would be. And now they're looking at having to either hold on to a property, not be able to assign a property, having to come up with some practical solutions. So I think that's kind of what I'll speak to, is just, what do you do when cash flow starts to get tighter because the interest rates are rising faster than the rents? And from a practical perspective, cash flow is really just a function of revenue minus expenses, which is rent minus expenses. So if you're going to attack it from the rent side, how do we increase rents? Well, in markets that have quicker turnover, where we can give tenants 90 days notice, a really easy way to increase rents, if the rents are increasing in a place like Alberta or New Brunswick, would be deliver your month-to-month tenants a 90-day notice, do a renovation, re-tenant the property. In markets where it's much more difficult to do that because there's rental raise restrictions, and the tenants, even on month-to-month, are allowed to stay, like Ontario and BC, still look for the opportunities to increase the rent if you can. That one's a little bit trickier. If you have a vacancy or a pre-sale vacancy coming up, you might want to consider going from year-to-year rental to either medium-term rental, executive furnished rental on a month-to-month basis, or even short-term rental. Yes, it creates a lot more work, but that's the rental numbers that you get from shorter and shorter term rental do increase the rent. That might help balance your numbers. Attacking it from an expenses perspective, I'm just going to echo Dalia's comments on some of the creative strategies she talked about to impact your mortgage, either deficit financing, bringing on an equity partner, or refinancing the portfolio. Taxes, can't really mess with that. Insurance, yeah, maybe you get another quote, can't really mess with that. So let's look at the three main areas that you have control of over as the owner of the property, which is repairs and maintenance, vacancy allowance, and property management. Those are three areas where, if things are getting really, really, really tight, you might want to consider taking full accountability for your portfolio and rolling up your sleeves. Base property management in most markets is 10%. 10% savings can be the difference between positive and negative cash flow. Repairs and maintenance, again, we always talk about outsource, delegate, but you might have to do a little bit of repairs and maintenance to your own properties. And attacking vacancy, well, again, we know a property manager managing 500, 600 doors isn't going to fill the vacancy as fast as you are as the owner, taking accountability for the property, making marketing and promoting and showing that property your number one priority at all times. So there is really 20% of the revenue up for grabs in a scenario where your options are starting to close in on you. You're not all hope is lost. If you're willing to roll up your sleeves and take a little more accountability for managing and maintaining your own portfolio in the short term, you've got 20% to play with that you can add back into your revenue in the short term. And with interest rates stabilizing in all markets, we're watching rents increase quickly to catch up. So it might make for a tough year, might make for a tough year and a half, but at the end of the day, that can be part of your success story of the time in 2023, 2024, where you had to roll up your sleeves for 12 months.
Yeah. I love, James, that you said that, because that is literally one of the most unpopular ideas for most investors. I'll be honest, a lot of us get pretty comfortable in the idea of having someone manage our properties for us. And, I don't want to manage my own property. That sounds painful and it sounds hard. And literally, sometimes we're in the situation where, we don't have the ability or the opportunity to hire a property manager. And quite honestly, the times where I have checked back into my business and gone, what exactly is going on here? Where is this number coming from? What is, who are my tenants? What are the issues in my buildings? Those are the times where I have been able to turn things around really quickly.
Yeah, you can really move the needle when you get your hands back into the property, because nobody's going to take care of your assets more than you as the owner of the property. It's just a fact. All of those other professionals, be they contractors, property managers, etc., you're one client of a client list. Whereas when it's yours, you're giving it your undivided attention. So you can create a magnification effect where you take on some of the repairs and maintenance, vacancy filling, and then you find opportunities to optimize, which allows you to squeeze a little more rent out of the other side of the equation, tying back into revenue. And so, again, unpopular opinion, because nobody likes doing all the hard work these days, but sometimes it's rolling up your sleeves and doing that hard work that can save your portfolio if you're willing to just roll up your sleeves for a couple of years. And, not losing a good property is just as impactful as buying another good property.
Yeah, you're right. And you know what? Honestly, there's a lot less cost associated with turning around an existing asset than there is with getting out there and buying a brand new one.
Absolutely. So, I mean, it's for a lot of us, our holds are 5, 10, 15, 20 years. So, a year of having to just put in a little bit of extra work into the portfolio in the big picture can be a really, really useful deployment of your time asset. Because we always talk about how to deploy the cash, but time is the other resource that you have to put in your portfolio.
Yeah, and it doesn't matter how much money we have, we can't get more time, right?
Exactly.
So Elizabeth, I
Fantastic.
can just jump in real quick. So James gave some great ideas there. And on the property management side, if you're in Ontario and BC, the one thing that I suggest is if you do take on the property management piece yourself, learn how to screen tenants. It's really, really, really important, those two provinces in particular.
Yeah.
Because the weights, if you get the wrong tenant, the weights now, let me give you a perspective. I literally just got a hearing notice today, finally, for a tenant that I filed for December of last year. And the hearing is going to be March of 2024. Okay. So you can end up, and that's a non-paying tenant. Well, I've got it managed and under control, but aside from that, is if it was out of control, that would be a problem. So just screen tenants in those particular provinces. Other provinces are a little bit better for dealing with this stuff.
Yeah, I'll shout out to Corey here for the Alberta Advantage. That turnaround time is usually 30 to 45 days in Alberta for a non-paying tenant.
Even better in Saskatchewan. So yeah, negative cash flow. That's a great one. Negative cash flow sucks. No one wants to be in this situation, but ultimately the building for multifamily, it has to cash flow, or it has to have a very short window to cash flowing. So you can't sustain problems for very long, especially in multifamily. And it's not just interest rates. Anybody who's owned an apartment building in the last 7, 8, 9 years knows, like, essentially, like, rents have basically doubled since the 70s. Expenses are up 6 times. And especially this past year, like stuff like property taxes, insurance, R&M, a lot of these costs that, these all-inclusive ones, carbon tax is massive now. It's a third to half of your gas bill in some cases, right? It's all-inclusive rent, and you can only shovel so much of that back to the tenant. So, for me, I've largely affected mostly by that. But the flip side is we're now in this low vacancy market where we're starting to recover that. So I was in a situation where, yeah, there was really no short-term path to cash flow. So I basically, just did what I could, and I did exactly what you guys were saying. I leaned out absolutely everything just to survive, to make it to better days. I mean, a lot of investors that are listening here today, they're facing negative cash flow for the very first time, right? And this is one of these things you got to nip in the bud early. Like, you have to get on it immediately. Like, I would do a complete portfolio overhaul, like every 6 months, your total debt service, how much positive cash flow you are every month. Because yeah, these things are very important, and especially with multifamily, like I say, it's who knows where it's going to go. I mean, the carbon taxes are going to keep going up. We have provinces like, Ontario and BC where, it's very restrictive in getting a tenant out and raising rents. So very, very important to manage that in the business. Now, I don't think I would want to take on property management myself. I did that for my first building, and I think that would be last resort for me, but it's definitely on the table.
Wonderful.
Elizabeth, may
Yeah.
I make a comment on negative cash flow that I actually forgot to mention?
Yeah.
Okay, so one of the other things I've seen investors do, which is counterintuitive right now, is to invest in a strategy that generates cash flow to offset some shortfall on the portfolio. So I'm seeing investors, some investors are still raising capital, are able to buy deals, not necessarily turnkey, but there are strategies that are working today. There are strategies that are no longer working today. My point is, you can invest to generate cash flow here, and you don't need to keep all of it. You may be using some of it to offset some shortfalls on one or more properties, depending on the strategy you're creating on this side. So I just wanted to share that.
Yeah, absolutely. And you're referring to strategies like private lending and rent to owns and midterm, short-term rentals and some of those other strategies.
Yes, absolutely. Yeah, exactly.
Fantastic. Absolutely. All right, Christian, over to you to tie it all together and put a bow on it for us.
Well, there's some great ideas here. I mean, you know, these guys are a hard act to follow, honestly. So the unique angle I'm going to bring into this, and you've heard me say this before, Elizabeth, is it all comes back to the business case. So when I buy something, I have a plan. Okay, it's not just arbitrary buying things. It's I buy something because I have a plan on how I'm going to make money within a certain period of time. I'm going to do something to the property. I'm going to fix the property. Something's going to happen. And then by the time I'm finished, I've got new money that I've generated. I've generated new value. And that's, you know, when we were talking in the chat about refinancing and stuff like that, one of two things happens when you take that strategy. If you have a plan, let's say it's a 5-year plan, you take an asset, you're going to do something to increase its value. Maybe you're going to increase its density. Maybe you're going to change the nature of what the leasing is. Maybe they were bought with low rents, whatever it happens to be. So if you start off with a plan in 5 years to do something to that property, then what happens is at the end of that 5 years, you have two choices. One is everything is going great in the economy and you do a refinance, you pull out equity and you go do more stuff. The second option is the economy is terrible. I have to deleverage my debt. I now am in a deleveraged position because I've naturally brought it down in that 5-year period. So that's the way I always start, so that when things do happen like this, I'm in a naturally deleveraged position. Okay, so that's easy for me to say now, right? Because you know, people here are not necessarily hadn't necessarily thought through what their business case was, and that's okay. That's, you know, just the way it ended up. So this is where comments such as what Dalia and James brought in are absolutely key in terms of what they're suggesting is to pivot on your plan. So you may have had a plan right now that might have been just a simple buy and hold. You're basically hedging against inflation, maybe trying to get some principal, you know, reduction over a period of time and slowly deleverage, which is fine. And then things kind of got ugly, it got out of hand. So when we talk about what James and Dalia talked about, which is some pivots to generate new cash flow, you know, either through expenses, but the easiest one is actually around new revenue. So things like STRs, et cetera, make sense. And I'll give you an example. When we were going into the pandemic, part of the asset class that I have is office space. Okay. Anybody wanted to own office space during the pandemic? Right. I don't even have to see the show of hands. Right. It wasn't fun. And fortunately, I had a lot of leases that were going to span the pandemic, but I had some that were expiring right at the beginning of it. Right in the middle of 2020, I had a bunch of leases that were just coming to a natural end. And so the question was, well, what do we do now? Well, you change. Okay. The current plan isn't going to work, right? In the pandemic, you can't lease office space, at least not in the way that you normally think about it. So we did a couple of things. One is we said, well, there's a demand for light industrial space. So we reconfigured some space for light industrial, and light industrial was through the roof through the pandemic as all the trades became extremely busy. The other thing is to take a page off of what James said is in the office space, there's a short-term rental market too. You can rent out individual offices, not just 2,000, 3,000, or 4,000 square feet of office space. So what we found during the pandemic is people, you know, they were working from home, but they didn't want to work from home. Okay, because, well, the dogs, the kids, the spouse, all these reasons meant that they wanted to go somewhere else to work. And so they were willing to pay a premium for an enclosed office, which we had plenty of, as it turns out. Right. But the nice side benefit was we got a 50% revenue increase in revenue per square foot. That was huge. It supplemented our cash flow, actually increased the value of the building. And guess what? We're continuing with that model. So we're doing really well on those short-term rental office spaces, and we're continuing to do that. So things that James was talking about earlier was really, if you look at the revenue line, is very much about pivoting. Okay. What can you do with your property that will two things. Okay. What's going to increase the cash flow? Okay. Two things.
Can you hold on? Pause for 1 second there. James has to jump for another obligation. So James is just going to say goodbye to everybody. And then Christian, we can come back to you and then we'll move on to the next part. Thank you so much, James, for joining us.
Thanks, James.
See you in a few weeks.
Thanks, James. Great insight by James, really. So
right,
two things
back
you
to
want to look at your property. One is to do what James and Dalia said is ways to supplement your cash flow. They gave great examples, and we're not going to touch on that again. The second part is what can you do to the property to increase its value? Okay, you don't have to be stuck in what you're doing right now. If there's an opportunity to do something different and increase the value of the property, maybe it isn't suited yet. Maybe it's in a configuration where if you change it, you can increase the revenue profile for it. And when you do that, you get a secondary effect is you've deleveraged by doing that. So you're in a better position if you have to go and do a renewal, a refinance, etc., or if you need to do an equity takeout. So think about both paths, not just the cash flow piece is critical, absolutely critical, right? But that's survival mode, right? Get through it. The next question is, how can I improve this property?
Love it. And that's such a great point too. I like the idea that it's not just about, you know, deleveraging by paying down your mortgage, it's deleveraging by increasing the value. That's fantastic. I love that, Christian. All right, so I wanted to make sure we did actually a really good job of kind of covering all of our questions in sort of a roundabout way with all of the conversation. So I wanted to just pause for a couple of minutes before we go into the Q&A. So if you have questions for the people who are here, please go into the Q&A tab and share your questions with us, because we're going to have a few minutes to be able to answer your questions for you. And Dalia, I have a question for you as well when we come back. In the meantime, what I'd like to do just quickly, I want to take 2 minutes. And for those of you who are thinking, I'm really enjoying this webinar, I'm learning a lot, I feel like there's information here that I can reasonably apply to my portfolio. Maybe you're wondering what to do next. So for those of you who are not familiar with the Real Estate Resilience Summit, and I love that Christian was talking earlier about, you know, one of the hallmarks of being a good investor is our ability to be able to be resilient, is our ability to be able to pick ourselves back up in the face of adversity and challenges. When other people are leaving, we double down and say, how do I do more? How do I get bigger? So this is your personal invitation from Corey and myself to join us at the Resilience Summit in October. It's going to be the 14th and the 15th. It's 100% online. You can attend from anywhere in the country or really anywhere in the world. And even if you can't attend the entire weekend, you're going to have recordings that are available to you immediately, and you'll have access to them forever. So Corey's going to come on and just take 2 minutes and talk a little bit more about the event, and then we're going to circle back around and we will answer the questions that you have asked for the panelists. Corey?
Thank you, Elizabeth, and thank you, Dalia. Thank you, Christian and James. So I think everyone got a tremendous amount out of that tonight. I know I did. So maybe just some comments in there. Who attended the summit last year? And, you know, what were your thoughts? You know, we debated doing this a while back, and we decided we were going to go all in and do this summit one more time. So maybe just type in the chat if you were there last year. We are doing this all over again, October 14th to 16th. So here the comments are coming in already. Mark, yes, it was great. So fantastic. So I'm just going to spin through, you know, some topics we're going to talk about this year. So it's actually only 2 days instead of 3. So this time it's going to be broken down in Saturday and Sunday. Christian and I are going to open up. We're going to talk all about recession proofing our portfolio. You know, we touched on a lot of that today, but this is kind of the tease, the sneak preview into what we're going to be talking about on the summit. So we're going to be doing a deep dive on that. You're definitely not going to want to miss that. James Knull is an expert on densification. You know, he didn't get into it a lot today, but James was known as the basement suite guy in Edmonton, you know, for 20 years. Like, he's been specializing in this. So he's going to talk all about densification, different options, basement suites, coach houses. But I think we're going to focus more on the basement suite conversions. So as part of the opportunities piece, we're going to be talking about increasing your income. So we have Victoria Clooney and Noah Mogul. They're going to be talking about, you know, short-term rentals and other strategies that you can do, you know, to increase your income. So we also have creative. So this is where we have Rachel Oliver. She's a specialist in rent to own, and Jillian Irving, and she's going to be talking about student rentals, I believe. So this whole day is dedicated to, you know, to finding ways to finding opportunities. And then finally, of course, you know, we have Dalia. Dalia's session last year was just off the charts. I think I've watched it like 4 times now. I'm still taking notes on it. So I don't know. It's going to be tough to top last year, Dalia, but I really can't wait to hear what you have to say. Really looking forward to it. So Elizabeth, she's going to talk about repositioning underperforming assets along with Megan. You know, Elizabeth had a commercial property that she just did an absolute miracle on, and I'm so stoked to listen to this session and everything that she did to turn this property around that was underperforming. So that's going to be at 11 a.m. on Sunday. And then Mike Ponte is going to be talking all about raising capital and joint ventures. Now, this has really come under the magnifying glass lately, which is why we've also brought in some securities lawyers. So there's going to be a lot of Q&A around that. You know, people that might want to scale up. You know, how do you set up a joint venture? What do you have to do for a limited partnership? How do you steer out of hot water when it comes to securities? Because more and more of this is starting to, starting to, show itself now. So you want to be on the right side of that. We also have Tony, and he's just been a genius at social media. And I've never been very good at social media, but social media in real estate has become very important. You know, how we promote our businesses. So he's going to have a great set on that to show you all about that. And then finally, to end it all off, crafting a life you love. Gary and Adriana, they have graciously stepped in. They're going to have a dynamite presentation for us, on how to craft, the life we love, and mix work and pleasure with real estate. So we got a fantastic lineup, and the platform we're choosing. So if you guys have been there last year, I can see some of the comments again. A lot of people attended. This Excel events, man, is just mind-boggling. This year, we're actually, besides the lobby and the main gamification of competing with your attendees, we also have a speed dating feature we're actually incorporating in this. So on every one of the networking breaks, you're gonna have like 1 minute, blurbs where you just get randomly matched with somebody. So it's gonna be a great way to meet people. I talked to a lot of people that met someone online at the summit, and a lot of connections are made, probably a lot of deals too. So it's actually just like a virtual conference. We have a lounge where everybody can hang out. We have networking, just like a gigantic Zoom call. And the virtual expo is actually just like a real expo. There's an incredible amount you can do in there. You can visit the booths. You can interact directly with the speakers, download their stuff. They're going to have a ton of free gifts. So, we're really looking forward to this year. We're really stepping it up. And prizes, we're going to have some amazing prizes this year. So this is, of course, related to the gamification, which is, the more you're engaged, the more booths you click on, the more you chat. It's a very, very competitive atmosphere. And this was really the fun part of this last year. And the prizes were pretty good. And this year, they're going to be even better. But it's all about participation. So we have several educational packages we're giving away, like including Mike Ponte, Christian, Victoria. I'm probably going to throw one in there too. These are very high ticket items. So you're going to have a chance to compete for these. And we also have gift certificates, and a lot of prizes are going to be coming up. But the key thing is every single speaker has a set of gifts on their own. So every booth you go to, there's literally tons of value. I'm still actually going through last year and trying to go through some of these because of the ebooks and checklists and tips and free webinars and just all kinds of value that was packed into this summit, along with the live sessions. There's just so much more. So today I'm going to do a kind of a special offer here. I'm just going to put in the chat the link to buy the pass. So right now it's only $74. We have this deal going on for probably till the end of the month, a little while. But the first 3 people to buy, and you've already bought your ticket. There's got to be someone on here who hasn't bought a ticket yet. But anyway, the first 3 who are going to buy I'm going to give a free 30-minute coaching session, one-on-one. I did this last year, and I absolutely loved meeting with the attendees. And it's largely based on how we can make the event better. What do you guys want to see? But I'm happy to provide my expertise as well. So just click on the link, and away you go. So the first 3 that are going to get it are going to get that prize. So I'll be watching that, and maybe I'll even announce it at the end. So I know we're getting pushed for time here. So Elizabeth, on to the Q&A. And thank you very much.
Thanks, Corey. Appreciate that. All right. So we have Q&A here. Okay. So let me just, somebody said I missed the discount code. What was the 90% off? Elliot said, recording for tonight, when will it be available? As soon as my amazing assistant Mary Beth has done the edits, it will be sent out automatically to your inbox. Buyer just says, thank you, Dalia. Okay. So Nicholas said, what is the best way to monetize an unused storage or maintenance room in a multifamily building? So that, I think, is Corey and Christian's territory there.
Sorry, what was that? A maintenance? How to utilize space?
What's the best way to monetize an unused storage or maintenance room in a multifamily building?
Yeah, I actually just did this, and believe it or not, it was a storage room on a 17 suiter that's now becoming an 18 suiter. So I love this deleverage with increasing value because I've heard of this being done, but this is the first time I actually did it. You know, there was some fights over permitting, but it was literally a 220 square foot space. I did not think this thing was ever going to rent. We rented it for $950. The cost to do this suite was 80,000. So it's going to increase the value by 200,000 by doing this. We've actually just rented it out for 950. So any space that you have to utilize like that, it's not always easy or practical, but it's definitely one of the things you look at in multifamily. There is hidden value. Some people I've heard of some people converting like large one bedrooms into two bedrooms. There's a lot of creative ways you can create value in multifamily. And I know Christian has done this even one step further with commercial because he's done a lot of mixed use stuff and he's gotten really creative on some of his deals.
Yeah, those are great ideas, Corey, right? And picking up on what you're saying, 220 square feet is actually great for a micro suite, and it's legal.
Yeah.
So as long as you meet your building code requirements, you have the necessary windows, the exits, that kind of stuff as part of the solution. That can be, depending on the size of this area that he's got to work with. We have some units that are micro suites in Ottawa that we rent, and basement units, right? About some are 220, it's about 220 to 280, I think the range of what we have as micro suites, and we're renting them out at about $1,200. So
Wow.
now small spaces like that, the one thing that you have to do is staging is really important because 80% of people don't have a good imagination about how to use space. So if you can stage it and you can see how the space is productively used, it can do quite well.
Nice.
I have to think long and hard, being in Ontario, about whether I really want more residential tenants. So one of the things I like to do is to take a look, and depending on the size of the space, if I chop it up into individual storage lockers, and then I can fall under the Storage Liens Act, then I would rather rent out smaller spaces, as long as I'll end up coming in with more money overall. So if I can take the same space versus putting a residential tenant in and put in 10 or 12 storage lockers and end up farther ahead, I'm probably going to do that. And that's actually one of the things I'm going to talk about at the summit is getting ready to do that in my commercial building, because I literally don't want any more residential tenants. And it's kind of sad that, we're in this situation where there's so many people who need housing, and it just is such a daunting task for, small rental housing providers, for sure.
You've touched on a great point, Elizabeth, and our mutual friend Bruce Firestone is a big advocate of things like artisan space as well.
Mm-hmm.
So you can create these work areas that people can use in order, dress it up, make it, clean it up, etc. And you can lease it out as a commercial venue to do artisan work. And maybe even one of your residential tenants in the building may want this as an auxiliary space, right? And sometimes you may actually be able to, depending on other restrictions, you might be able to attach it to the residential unit. And what I've seen Bruce do as well is create commercial spaces with a residential auxiliary unit. And because it's primarily a commercial space, it's actually not subject to the RTA, the head lease with the CTA, the Commercial Tenancies Act. So there's some real super creative things, and that was a great thing for you to touch on.
I think the other thing sometimes too is looking at ways to make the building more appealing. So it's, what do I need to do, or what could I do in this building that's going to help me reduce my vacancy rate by maybe even creating a waiting list for people who really want to be in my building. So it could be things like adding the storage lockers. It could be adding coin laundry if the individual units don't have washers and dryers. Adding additional parking out back, adding a lovely, outdoor space where people can, sit in the summertime. These are all things that make your building more appealing when, they're looking at 15 buildings that all are structured the same. What makes your building the one that they want to live in?
Yeah, I mean, in Sweet Laundry, you nailed it. I mean, they have these ventless dryers now. That was a new invention, so that's becoming mainstream now. And you can literally get it used to be dishwashers. You could get $50 more if you had a dishwasher. Now it's just automatic. We just put dishwashers in, and we're starting to do some of these in-suite laundries because you can get 100 to 150 bucks more, especially since the pandemic, right? People don't want to use the common laundry anymore. So you're kind of almost left behind. if you don't have that, I mean, it's not always practical in all buildings, but it's definitely something that, you know, for a business case, that's an opportunity that you can look on when you buy a building that someone hasn't done, right?
Yeah. We also found vending machines. We put them in our commercial
Yeah.
buildings. It sounds so silly, but even gumball machines, like there's no kids in my commercial building, but those guys who are going to work in the mine, they'll come back on their way in the door. They're popping gumballs and all kinds of stuff. Like it's not just about, you know, how can I generate $100, but it's about how can I consistently level up and create additional streams of income, right?
Yeah, so I'll throw a few more in there. So you those are great ones. Other stuff we've done, we provide internet services as well. So we'll charge $50 a month per tenant, per unit, and we just add it to the rent. So we have the internet service there anyway because we have surveillance cameras and a whole or basically automation for our lighting sequences, our temperature management, etc. So we just resell the internet we're already paying for. And it's a commercial arrangement with the internet services. So it's not your typical residential one, but a lot of business internet services actually do allow you to offer it to other people within your building. Other things we've done is, because we do a lot of short-term rentals as well, is for some of our tenants, we've offered maid services. So you might be able to charge, I don't know, like $250 a month for maid services. And the cost of the maid will probably be about $150 or so. So you're going to make an extra $100 in profit on that. What else have we done? We've done clever stuff on garages. This is one of my favorites. We have some garages downtown, and where we have 5 in a row. And we used to have them, because they're downtown, we used to just rent them out. I think originally they were rented out when we bought the building about $100 a month. It was ridiculous, especially when the going rate downtown was about $200. So the first thing we did was just increase the rents to $200 a night, or $200 a month. I wish it was a night, but per month. And then one of the things that we figured out, we were just watching the news one night, and they were talking about the winter parking ban. Okay, so in Ottawa, like a lot of cities, you can't park your car on the street overnight when there's snow above however many centimeters in your particular municipality. So I suddenly realized there's a lot of people that need to get their car off the street at night. And there's a lot of people that come downtown to work during the day. But most of our garages were empty at night. So then we started renting them in shifts. So we would do like an 8 to 6 shift, right, for people who were working downtown. And there was a 6 to 8 shift for people who needed to get their car off the street at night. And in order for you to have that 6 to 8 shift at night for the winter, you also had to carry it through the summer, right? So you couldn't just pick and choose what days you had it, because there was no guarantee you were going to get it in the fall, right, if you didn't keep it. So we managed to take that, $100 up to $200 up to $350. Right, per garage.
Wow.
So you can be really super creative, if you want to think outside the box. There's all kinds of cool things that you can do.
Absolutely. And this is going back to James's point. This is the kind of thing these are the kinds of opportunities that you see when you're active in your market and when you're paying attention to what's going on in your business, because a property manager probably wouldn't have seen that and wouldn't have seen the opportunity to do that.
You're the business owner. They charge.
Absolutely. Okay. Okay, a couple more questions. So Dave Kimball asked, is there some app that makes it easy to rent out unused, underused storage spaces? I personally haven't heard of one. I don't know if you guys have, but if there isn't one, then Dave, I think you found your next project for the winter. Have you guys heard of anything like that?
I've only seen storage locker management systems, but they're all built in one, i.e. A lot of the larger buildings have these storage cabinets and so on that have apps to manage it, etc. But it's all outsourced and managed by a third party in that case. And then you can get some level of revenue share. So that's all I've seen. I've seen parking stall management. I've seen, let's see. Well, a variety of things, like parking is a big one, right? So, and there's a bunch of apps for those things, but.
Fantastic. And somebody asked if garden suites and coach houses were a good investment strategy.
They can be.
Mm-hmm.
So the cost of building them is coming down. Right now, a lot of people are being quoted in the order of 200 to 250K to install a garden suite in the backyard. Because remember, you're going to tie in services with that as well. So it's not just the construction cost. And that makes it a bit challenging in terms of the return. I'm sure Dalia has seen some projects already, so I'll let her follow on. But what I'm seeing is businesses that are trying to support the intents of, for example, in Ontario, we have Bill 23, which has basically made all residential buildings a de facto triplex. And you can do that with auxiliary dwelling units. So it can be suiting or it can be a coach house. So because of that, there's the potential for a lot of technology to bring that cost down so that you may be able to deliver a coach home for, say, $150,000 cost onto the lot. And the value of that would probably be, depending where you are, between $250 and $350. So there's a lift that can be had there for sure. Dalia, I'm sure you've seen some of these already done on a refi basis.
Yeah, I would like to share a comment on the residential side and the commercial side for this particular strategy, because here is what we're seeing, okay, and how it actually things you need to watch for. So obviously investors are building them to add more income, right? And because of Bill 23, like you said, Christian, and really after completion, they want to turn around and take out money after the value has increased, right? So on the residential side, it is really important for us to see how you would qualify as a client on exit, because some residential lenders, believe it or not, are still not taking into account the value of that third unit because it's not attached to the main structure. So we want to make sure you don't go down that route to get surprised on exit that you can't take the money out. That's on the residential side. On the commercial side, I am seeing a very cool implementation of this model. So for investors who are able to add units to make the total legal units at least 5 on completion, what we're doing is we're able to fund up to 100% of the cost of the construction and up to 80% or 75% of the existing value, like to acquire an asset, and then refinance on exit with CMHC on extended amortizations, or under the MLI Select program if they're building with energy efficiency in mind, which is a very cool way of doing it, because you're getting construction money, and on exit you're getting, you know, cheap money at 4.5%, 5% at 30, 40, 50-year amortizations, depending on, you know, how you fit into this new program, no longer new, but CMHC MLI. So I find it to be a lot more powerful right now on the commercial side.
It's funny because Jen just asked a question about how we feel about tiny homes, putting them on a double lot for additional income. And I guess my takeaway from that, Dalia, is tiny homes are fine as long as we put 5 of them. If we have
Right.
5 tiny homes on that lot, then we can go with commercial financing.
Yes, and we'll always run the numbers up front, Elizabeth, to see will these 5 legal units debt cover, because that's how commercial financing work, right? How much loan can these units generate, qualify for, so that you don't want to inject money into the deal up front and get stuck on the back end. That's the idea always, right?
Yeah. Yeah, we've seen a lot of that lately with the, the valuations of properties coming down. Is, the BRRRR strategy in a lot of markets in the last, year and a half has really not been executed to the same degree that it was in the early 2020s.
Yeah, very different. Yeah.
I see
Wonderful.
Janelle had something on there about commercial. It's the micro suite. So I think this is like if you buy a building that they're not legal, how does the bank look at that? That's probably more of a Dalia question on the commercial, because I've seen non-conforming suites, that there's one that doesn't have a meter, it's on the house meter, it's not legal. Maybe for some reason you can't make it legal. How does the bank underwrite that if you're trying to purchase a building like that?
So if the unit is legal or legal non-conforming, the bank can use the rental income. If it's not, then it's zero income from that unit, whether or not it's rented, it's zero income that they would use in their calculation.
Okay, it's a fairly straightforward answer then. That's what I thought.
Yeah,
You can legalize it though, right? So, you know, as long as it's within the zoning, meets the zoning requirements, you can legalize it. We've bought buildings where there were illegal units and we just legalized them. And depending on the municipality, there's sometimes some advantages. So for example, in Ottawa, let's say the one unit that we were going to create is smaller than any other unit in the building, the development charges are waived. Right, so that's a big plus. And you don't really want to be carrying an illegal unit because an illegal unit really kind of implies there's a high risk of fire code violations, which come with big fines and criminal charges if somebody gets hurt or dies. So there's other liabilities that you incur with illegal units. So if you've got something with illegal units, you really should consider how to legalize it. And at the very, very least, make sure that you meet fire code.
So a lot of these owners, they've had their mortgage paid off forever and they just added one and they just never bothered. Like, was it just a hassle for them? Like what other reason would they have for not legalizing it?
What I've seen is it's just that they think the process is just going to be too heavy and they just want to do what they want to do.
Yeah.
Yeah.
That's,
Or they don't want to spend the money doing like the double thick drywall, because it is more expensive to create a unit that's fire code compliant. And there's a difference between complying with fire code but not legalizing and just doing, you know, kind of a DIY basement apartment. And quite
Yeah.
honestly, I personally couldn't sleep at night with a DIY basement apartment, because if there was a fire and people died because I hadn't spent the money, to me, the money is worth somebody's life. And that's exactly why fire code is there. I can't, there's not a whole lot in fire code that's like, you know, worthless or useless. Most of it is designed to give people enough time to exit a building in the event of fire. In fact, I can't think of anything that's like not that doesn't satisfy that mandate.
Mm-hmm.
Okay, so I would like to wrap up for the evening. There's still a couple of questions, Dalia, that I think the questions in the Q&A. I think Christian and Corey, if you guys can answer one, and then there's another one there that's for you if you guys would like to answer for people. And I will wrap up the webinar. I can't thank everyone who attended this evening. Congratulations for, I know this is probably one of your first networking events coming back into the fall, and congratulations. Thank you for spending your Monday evening with us. And thank you, of course, to all of our wonderful and amazing speakers. And in case you didn't notice, everybody who's a speaker this evening is also going to be on the summit. And one of the things that we did this year based on feedback from last year was we extended the length of all the sessions. So it means that we can go deeper than we were able to do last year, and we'll have more opportunity to provide more information and insight for you.
yeah, the Q&A last year was insane. Like the presentations were just off the charts, and then the Q&A was amazing. So I can actually announce the winners here, if that's okay, Elizabeth. Do I have 30 seconds to do that?
Oh yeah, absolutely. I'll leave the contact info up so people can copy it down or go wherever they want, and you go right ahead and announce our winners.
Okay, so Trevor Coyle, Coyley, hopefully I said your name right, Trevor Coyle, Trent Smith, Catherine Nielsen, Riley, and I'm gonna add a fourth here, Adam Merritt, because he's a student of mine. And I'm due for a coaching call. So those are the four. So congratulations, you guys. Thank you for supporting the summit. We're gonna do this again next week on the different topic of the creative cash flow.
Wonderful. Thank you so much, everyone, for attending. Thank you to our amazing speakers. And Trent, it'll be nice to have you back, because I remember you from last year. You're in PEI. We don't get a lot of people from that far out east, but Christian in particular has a soft spot for the East Coast. So thanks so much, everyone. You'll look in your inbox in the next 48 hours for the recording, and we hope to see you all again next Monday when we have different experts and a different topic to cover. Take care,
help
everyone.
Spread the word. Thank you so much. Tell all your friends. We love this stuff. We can't wait to see you guys 32 days from now.
Oh, wow. Okay. Thanks, everybody. Take care. Have a great week.